Hello, in this video, we're going to be talking about fractional reserve banking. This is the type of banking system in the United States and many other economies around the world. So the fractional reserve system is where customers deposit money into their banks, and then the bank takes some of those deposits and lends it out to other customers or invests it. So reserves is going to be how much of customer money they have to keep on hand, and fractional just means they are only keeping a portion of it, only keeping part of it. So for instance, if I have a savings account with my bank and I deposit $1,000 into my savings account, when I go look at my statement, it'll say that I have $1,000 in my savings account. But the bank doesn't just hang on to all of that money. What they do is they leave that on on my account statement, but they might actually take $500 of this and lend it out to another customer. So every time you get a car loan or a student loan or a home loan, any type of loan you get, you're actually borrowing money from other banking customers. Banks do not keep physical currency equal to deposits. So if you remember from our lecture about money, we actually have a very small amount of physical currency compared to the overall money supply. And banks are not required to keep physical currency on hand equal to deposits. They're also not required to keep their electronic deposits on hand as reserves. Banks are actually part of the money creation process. So lending out customer deposits expands the money supply, it expands GDP, it lends to economic growth, and so it's actually a very important function of the economy. Currently, there's no set amount that banks have to keep on reserve. It used to be that the Federal Reserve Bank would set an amount that banks had to keep. So they might say, you have to keep 40% of reserves. You have to keep 10% of deposits on reserve. And currently, there's no actual number for that. So how much should banks lend and how much should they keep on hand for customer deposits? So a lot of this has to do with predicting human behavior, trying to guess how much money people are going to need to use in the short run versus the long run, because banks also want to make money, right? They're not just there to be friendly and make it so it's easier for you to get your paycheck direct deposited. They're there to make a profit, right? They have employees to pay, they have to pay the building. So one of the main ways that they make money is by lending out or investing customer deposits and earning interest on that money. The amount of financial uncertainty currently and in the future is going to affect how much banks keep on reserve. So if they feel like they're not really sure what's going to happen next year or this year, there's a lot of volatility in the economy, they're going to keep a lot more on reserve. So they're going to lend out a lot less money. If they feel like, okay, things are going well, the economy's doing well, people have a lot of income, they're going to be saving, we can lend more of that out, then they're going to lend out a higher percentage. Interest rates are also going to affect how much banks are lending out. So the interest that they have to pay if they need to borrow money to meet customer withdrawal requests, the interest rate they can charge on mortgages, the interest rate they could earn from government bonds or other investments. And then the demand for checking deposits. So how much are customers going to be withdrawing and how quickly? So if you're putting money in your checking account and you're using all of it up within a week or so, that bank is not going to be lending out your money for anything long term. They may do some short overnight loans to other banks or other things to make money, but they're not going to earn that much interest on really, really short term loans. Okay, so why do we not have required reserves? It seems a little bit scary, right? Banks can just lend out 100% of customer deposits. Doesn't that leave the banking system open to failure? In 2020, the Fed, which is the Federal Reserve Bank, central bank in the US, actually decided to end its required reserve policy. So prior to 2020, they as part of their policy setting interest rates, buying and selling securities, they would also determine the required reserves. But what they found, especially since 2008 recession, is that banks were actually holding excess reserves. They were holding a lot more than what was required. And since they were holding more than that minimum requirement, this policy wasn't really doing anything. It wasn't affecting bank behavior. And one of the main reasons that the Fed had a required reserve policy was because it was one of the tools that it tried to use to maintain the economy or fine-tune the economy. But since banks were holding on to more than what was required, they said, we're just going to end this policy. We'll try to manage risk and reserves in other ways. One of the ways that they're doing this is by paying interest to banks when they hold reserves in their own Federal Reserve Bank account. So our central bank also has bank accounts, not for individual customers, but for banking customers, investment banks, the government. And so what they said is we're going to pay interest to banks who put their reserves in our account. And this will incentivize them to hang on to reserves. It gives them a little bit of interest, so they're not losing money by hanging on to reserves. And as the Fed changes that rate, increases or decreases it, it can essentially have much greater control over the amount held in reserves. They can still reinstate required reserves if deemed necessary, so they didn't eliminate their power to do so. They just said, we're putting it at zero and we don't plan on doing anything with this. Banks are much more likely to lend out savings account deposits or time deposits rather than checking account deposits. Money in people's checking accounts is generally spent a lot more frequently. If you have money in your savings account, it's usually going to stay there for several months, possibly several years. A time deposit, sometimes called a CD or certificate of deposit, is where it's basically a savings account that pays a little bit higher interest rate, but you are required to leave your money in that for a certain amount of time. So you can get a 3-month CD saying you're not allowed to take your money out for 3 months, 12 months, a year, 5 years. You can get them for many different amounts of time. And so the longer that your money is in there, the higher interest rate you could potentially earn, because the bank knows that they can safely lend out that money. They're not going to have to borrow or call in that loan if you try to withdraw. Checking deposits have a high demand for liquidity, meaning they're going to be spent. So they're much more likely to be held in reserves. Here's a chart. This is from Federal Reserve Bank in St. Louis, and this is showing reserves of depository institutions. So this is the total amount of money that banks have held in reserves. So from 2015, we had about $2.8 trillion. January 2019, it dropped to about $1.6 trillion. And then January 2020, when that reserve requirement was lifted, we see that it jumped up, right? So reserve requirement goes to zero, and now banks are holding $3 trillion in reserves. Or 2022, they had over $4 trillion in reserves. So removing this reserve requirement has not increased the amount that banks are hanging on to. In fact, one of the reasons it might increase it is because they're not being given permission to spend or lend out 90% of deposits. They sort of have to figure out that amount on their own, and so they might be a little bit more cautious. Okay, so what is a bank run? You may have been hearing about bank runs or bank failures in the news. This happened in 2008. We had some bank failures early 2023. Generally, it's smaller banks, but it can happen to the entire financial system. It can happen to any bank. So banks are subject to panic because they don't keep all deposits on hand. So if you have your money in a checking account, say you deposited $1,000 into your checking account, you know there's lots of other deposits from other customers, but you know that the bank is only keeping 20% of all deposits in reserve. So if all customers want to withdraw their deposits, you want to all spend all the money in your accounts, only the first 20% that show up to take their money out are going to be able to take it out. Otherwise, the rest of them are going to say, sorry, we don't have your money right now. Your money is currently being spent on Joe Smith's house, right? We lent all of that out last week. We were not expecting people to take this much out. And so if all of a sudden you're concerned about the bank's ability to give you your money back, you may go try to pull all of your money out of your accounts, even if you don't actually need to spend it right away. So a bank run is when customers all run to the bank and try to pull all their deposits out. All right, let's get there first. We know you don't have enough cash available. We know you don't have enough electronic reserves. I want to take my money out before the bank collapses and nobody can get their money out. So get your money out first before the bank runs out of money and fails. If you have a bank account with a commercial bank, these are FDIC insured, so up to $250,000. So savings and loan, credit unions, all the normal type of banking, things that you could get a checking account are going to be FDIC insured, which means if your bank fails, you'll be able to get your money back up to $250,000. So if you have $1,000 in your checking account, your bank goes under, the Federal Reserve Bank will make sure that you get your money. The idea here is that it's going to help prevent bank runs because you're not going to lose all of your deposits if the bank fails. So all of the smaller customers are not going to be pulling their money out. If you want to watch some movies about this, see it in film. Mary Poppins, the original one, not the newer, I think 2010 one. This is dealing with London in 1910. So you can watch that here. Or you can watch this clip from It's a Wonderful Life. And this is dealing with some things happening in the United States in 1945. So both of these clips are looking at some current events, throwing it into movies. I will also put these videos on the Canvas page about this topic. So the banking system is extremely important to the way that our economy works. We need access to borrowing for investment. This helps increase our capital production, expand economic growth. It allows consumers to smooth their consumption over their lifetime, borrow money for student loans, borrow money for a house. So banks and financial markets facilitate borrowing and lending. They provide a way for people to make choices at whatever time they would like in their life. So rather than having to save up $500,000 to buy a house, as long as you've got the down payment and the income to make the monthly payments, you can borrow money and get that house now. You can also earn money on your savings account. So you put your money in the bank, they're going to pay you a little bit on your savings because they're lending that out and earning interest. They're sharing some of that profit with you. Some savings accounts have higher interest rates. I recommend looking for a high yield savings account. So there is Marcus. There's a Marcus account by Goldman Sachs. So that has a fairly high interest rate, usually higher than the general savings rate. So during like COVID, when savings rates or interest rates were near zero, the Marcus account maybe was paying 0.5%. Then once inflation jumped up and was 6 to 8%, you could earn 3.5 to 4% on that Marcus savings account. Or generally like other types like Chase Bank savings account, I don't know. It's something so tiny. I'm just earning like a few cents. The Marcus account, you can earn $5, $10, $50 a month, depending on how much you have. There's also Capital One 360. I think they have a high performance savings account that pays a similar rate to Marcus. So look for high yield savings accounts. One of the features of these is that you make a higher interest rate, but you also don't have as much liquidity. You can't access that money as fast. So you transfer it in, it's going to take 2 or 3 days for the money to arrive in your account. And then if you want to spend it, you need to transfer it back out to a different checking account, and that's going to take another 2 or 3 days, possibly more, depending on when it is. So it is good for earning money, good for earning money on your savings, but it just needs to be money you don't need to access on a daily basis. So banks and financial markets are necessary for modern economies to function. And when everything is working well, these systems facilitate growth, they create wealth, they increase the money supply. Banks and financial markets are intertwined, and the failure of one can cause all of the markets to collapse. So they can knock down like dominoes. They are all invested in similar types of things. And so one bank failing can cause a ripple effect or a domino effect in the market and cause a whole bunch of problems and cause a financial crisis. Some examples, more recent examples, in 2023, the Silicon Valley Bank and Signature Banks failed. Silicon Valley Bank depositors lost confidence. They were concerned. They said, okay, Silicon Valley Bank has a lot of really big depositors, people whose money is not insured. So if you're looking at those accounts where they're insured for $250,000 each, if you have a lot of small customers, then most of your bank's deposits are going to be guaranteed or insured. But if you have big customers, a lot of big customers who have millions of dollars in their bank, potentially billions, it gets a little bit trickier. So one of the things happening with Silicon Valley Bank is they had a lot of large customers and not so many small customers. And so they had a lot of uninsured deposits. And so when people were concerned that the bank was going to go out of business, they started pulling out their money, especially those larger firms that had a lot of uninsured deposits. The problem with doing that is now the bank might not have enough money to meet normal withdrawal requests or to make normal payments. And so that is what causes the bank to fail. One thing that happened when they had all these big withdrawal requests, Silicon Valley Bank had to sell some of their investments. So in previous years, they had invested some of their money in, mortgages or business loans, but they also bought some government treasury securities. These were considered safer, and we're going to talk about that more, I think, next week. But they also pay a lower interest rate. When interest rates are near zero, this is not a big deal. You can have some low interest rate things. But right now, or when this happened, when interest rates were much higher, I think they're about 5 to 5.5%, having to sell a bond that's only paying 1% means that they actually lost money on those investments, further reducing consumer confidence and having people try to pull out more money, withdraw more money than was in the bank reserves. One way the U.S. responded, government, FDIC, Federal Reserve, was that they said, we're actually going to guarantee all deposits for banks right now. We're going to make sure every customer at Silicon Valley Bank and Signature Bank gets their full deposit back, not just $250,000. And part of the reason for this is that they want to instill confidence in the whole banking system around the country, because they don't want people to start pulling money out of all the small banks and causing a whole bunch of massive bank failures. In March 2023, the Fed planned to increase interest rates. They still did increase them, but they only increased it by, I think, 0.25%, so 0.25, rather than a much larger amount, because they realize that some of these current policies that are intended to battle inflation are causing some of the problems in these banks. Then there's the problem of, how do we keep these markets stable? How do we protect customer deposits while also not encouraging banks to make bad decisions? So the idea is they're going to hold banks accountable. So they said, Silicon Valley Bank, Signature Bank, you don't get to be in business anymore. We're going to sell your accounts to another bank who has more money, the funds to cover withdrawals. There's going to be some sort of consequences. So if a bank makes too many risky investments, or they lose too much money, or they're not keeping enough in reserves, the FDIC, the Federal Reserve, the government could come in and shut those banks down. And so that's sort of trying to keep a balance between holding them accountable while also protecting customer deposits.